The Indian rupee is one of the worst performing currencies in 2025, down nearly 4.5%, while most other Asian EM currencies have actually strengthened versus the dollar. Today we saw a sharp fall in the rupee, but it has lost 1 rupee 30 paise or 1.5% actually since November 18th, when the all-time high October trade deficit was announced by the government. Separately, bond yields have been rising since last Friday, November 28, when the Q2 GDP data was announced. The data has convinced many in the market that a rate cut is not a certainty on December 5th from Reserve Bank. To discuss the bond and rupee market outlook, I have with me Dhiraj Nim of ANZ Research and Suyash Choudhary, the head of fixed income at Bandhan AMC. Gentlemen, good morning. Thank you very much indeed for your time. Let me start with you, Dhiraj. What is the sense? I mean, from November 18th, of course, the rupee has been depreciating all year, but it has been a fairly sharp depreciation from November 18th. Now is like 90 round the corner. That's the chatter, at least.
Thank you for having me on the show, Latha. I do think 90 is very much on the cards for the rupee. Look, I think the biggest factor is us not having a trade deal, at least by the expected timeline. Now, there's a whole lot of uncertainty as to when the trade deal would happen, which means that not only a future economic growth is at risk, of course, we are also experiencing a widening of the current account deficit. Capital flows remain deficient. So all of that points to an adjustment in the currency, which is also warranted from an economic perspective. I therefore do think until we have a trade deal and we know its fine print is actually favorable for India, the rupee should continue to weaken at a moderate pace.
You know, normally for the fundamentals of the rupee versus the dollar and other currencies, we look at the 40-country REER, the real effective exchange rate. The last one published by the RBI in the November bulletin actually showed the rupee undervalued. It was at 98 or 97. So doesn't that count for something? I mean, it's fallen enough. All this bad news of no trade deal, capital outflows, current account deficit is all in the price, isn't it?
Well, I'm happy to see the real effective exchange rate actually below 100. I personally do think that for India's exports and manufacturing to do well, we should pursue a competitive exchange rate, if not a significantly undervalued exchange rate. But we also have to keep in mind that the real effective exchange rate has spot element and also the CPI differential element, the inflation differential element. Of course, India's current CPI inflation is exceptionally low, and we expect it to turn around, starting Q2 2026. And therefore, that tailwind to the real effective exchange rate would suddenly vanish, which means that if you want to keep the rupee on a competitive footing, you would have to ensure that there is sufficient spot depreciation in the currency.
Oh, okay. Okay, so by the second quarter, you are expecting even more depreciation. Okay, let me veer my attention to the bond market. Suyash, the Q2 GDP number appears to have been bad news for bonds. We've actually seen yields rise. How are you reading it and its impact on what we should hear on December 5th?
I would not overread that, Latha. There are certain distortions in play that economists and the market well recognize, including the very, very low deflator. Also, if you see RBI's commentary on growth is forward-looking, their concern largely pertains to the second half of the financial year. And therefore, that concern may not have gone away, although the first half gives a good base upon which that concern rests. As far as the policy day is concerned, look, the marginal utility of the next rate cut is rapidly diminishing. After 100 basis points, whether or not to go for the last 25 basis is basically a judgment call. We think since the governor and the MPC have guided so clearly, they will go ahead with that rate cut. What the bond market will also look for is commentary that does not transmit volatility or uncertainty to the market. So October policy did a very good job of commentary that gave reassurance to the market that a benign rate cycle is in play and will remain in play for some time. And that will be equally important as much as the rate cut would be. And third is, with RBI stepping up rupee defense, core system liquidity on a projected basis will diminish, especially so because over Jan to March, you will have rise in currency in circulation as well. And bear in mind, this is busy season on credit, so credit to deposit ratio is also rising. So third element will be the guidance on liquidity. and the extent of proactiveness that RBI shows in shoring up core liquidity, the bond market does expect somewhere around 2 lakh crores of OMO purchases from RBI over the next 3 months, which I think is a fair expectation to have. So all told, we are probably in a range as far as the bond market is concerned. The direction of travel on some variables like current account deficit, etc., have worsened a bit, but the levels there are still such that the bond market needn't sell off much more from where we are.
Okay. In case both of what you say happens, the Reserve Bank does cut and guides that it will remain benign. They can't say they will support growth, but I guess they can think of something benign. And they give this 2 trillion OMO announcement later in the day. I don't think that will come as part of the statement. But if they were to do that, what is the range for the 10-year?
Look, so first of all, it may not even come later that day. It may come over a course of time. However, what the bond market will seek is assurance that such a tool is very much up and center in the toolkit. As far as the 10-year is concerned, look, 10 basis point plus minus from where we are. The curve has also bear flattened a bit over the last few days, which is to say that shorter end yields have risen somewhat, expecting some bit of confusion with respect to whether the rate cut would happen or not. We expect that would sort itself out. One underlying issue that remains in the bond market is lack of risk appetite, and therefore, combined with the kind of duration supply that the market has, we would expect the yield curves to remain reasonably steep. And we think really the plays in the bond market are, 5 to 7, 5 to 8 year segments more than anything else, which are a pure play on the rate cut and OMOs.
Okay. Dhiraj, how much will this prey on the bond market, on the currency market? The fact that there is going to be more liquidity, that also is usually rupee negative, and the fact of the rate cut. Will that add to depreciation on the 5th of December and thereafter?
Well, I think so. I think that the rate cut is not fully in the price, so to speak, from an FX perspective. So if the RBI goes ahead and delivers a rate cut, which I think it must for the sake of the economy, I think some pressure on the rupee can be experienced. And like Suyash said, I also expect, some amount of liquidity support to come through from the central bank to support the bond markets, if not in this particular statement, then perhaps later. And all of that should weigh to some extent on the rupee. But that's part of the broader adjustment I believe the rupee should be exhibiting in the current scenario. When you're thinking of future growth, which could be sub-potential on account of tariffs, which look like here to stay at least for a while. And if your CPI inflation is going to climb up in FY27.
Okay. I'm going to ask you a difficult or maybe even impossible question. When the rupee gets that attractive at like 90 rupees per dollar, and, growth, if you go by the auto sales, even for November, it looks pretty decent. Wouldn't there be a point that FIIs would find attractive, that capital flows start coming in? Would that be in December itself?
Well, I would think so. That's theoretically true, but I somewhat differ on the growth momentum bit. Look, of course, the Q3 GDP was very strong, but I would advise to take that number with a pinch of salt for the kind of estimation issues that we have usually been challenged by. In fact, our in-house growth nowcasting model showed that we have about 92% of 40 indicators we use for predicting monthly GDP growth. And in October, it likely eased by about 20 basis points than where it was in Q3. So it's tracking about 6.5%, 6.6%, which is very good by itself, but certainly not so hunky-dory that we don't really have to worry about growth. In fact, if you go by the commentary that's come from the government as well as the RBI, the worries about tariffs staying and the kind of impact that they can have in the quarters to come can actually be very, very significant. And all of the data that has come in totality is telling me while GST has had a positive effect on some sectors of consumption, it may not have a very strong overall impact on the GDP growth in terms of headline GDP growth. So I do think that while composition has become solid in terms of domestic demand becoming more resilient, but I do believe that the growth rates at which India is faring or could fare in the coming quarters may remain a point of concern.
Okay. But Suyash, is there any space in the market or in the market mind that there could be 2 rate cuts? Will the governor indicate, okay, I've cut and there is more space to support growth, or is that just not on the cards?
Look, Latha, there's certainly a scope for 2 rate cuts from an argument's sake. I would caution against that, given that this still is a 4% dollar yield environment. Given that, like I said before, the incremental utility of rate cuts is now rapidly diminishing. And probably it makes sense to keep some buffers in play so as to be able to hold 5.25% on the overnight rate for a longer period of time. See, what you don't want is you cut rates to the maximum you can cut to, and then the guidance turns much more uncertain so that transmission gets compromised. And then you have to keep looking over your shoulder as to when a normalization cycle will begin. So it's much better practice, I would imagine, to just keep some buffers in play and try to hold the base level of rates for longer, supported by commentary that is reasonably constructive, flow of liquidity that is reasonable, so that transmission can happen on a broad-based manner.
Okay, very quickly, a final question, Suyash. What is the likely reaction if there is no rate cut? I mean, if the governor were to say that we want to keep the ammunition dry for a later day, probably because he's up, wants to keep one eye on the dollar rupee. It's already slipping. You don't want to give further fodder, and therefore doesn't give the cut, but says that space is available on a later day.
So it depends how strong that dovish guidance is. If the market expects that the very next policy is in play, then probably the reaction is not going to be much, especially so if OMOs come about soon enough.
Okay.
However, if the market senses that this may be close to the end of the cycle, then you could probably have a 10-odd basis point sell-off on disappointment on that day if it were to happen.
Okay. Dhiraj, what's your sense? Will the rupee be a reason why the Reserve Bank may postpone the cut rather than give it? Anyway, what's your year-end rupee target?
So for our end rupee target, we're looking at 91.5 by end of 2026. And this is assuming status quo on tariffs, and also want to importantly qualify that this is against our view of at least 4 to 5% weakness in the broad dollar index. So you can imagine the extent of depreciation, relative depreciation we're thinking of for the rupee. Now, in terms of whether the RBI would be mindful or consider rupee as a strong factor in this particular policy decision, I think that they have traditionally separated the tools to manage the rupee from the tools to manage domestic inflation and growth. And I think that distinction should continue, and it would be prudent to do so. While they do have sufficient FX reserves, they do have some runway on the forward book as well, although it is large, but they do have some runway. I think they will continue to manage the rupee and expectations around it from those tools in that toolkit, in the FX toolkit, whereas the rates at the moment should actually be exclusively reserved for domestic growth and inflation. We have seen a bit of a domestic demand recovery in the recent months, and I think a rate cut would do well to consolidate that, especially when you imagine that households had so much debt and debt servicing burden on their balance sheets at the moment. So I think rate cut for the economy and FX tools for FX. Let's keep that separate.
Okay. That's, I think, exactly how the Reserve Bank thinks. And they will be glad that the rupee market will not be terribly upset if there is rate cut. On the contrary, it may be seen as pro-growth. Out of time, but we will have to meet again to discuss both the bond and the rupee markets, post the policy as well. Thank you very much for joining us, Dhiraj and Suyash. Have to wrap up on Bazaar on that note. Chartbusters up next.